Well, good evening, ladies and gentlemen. My name is Jim Bantis, and I head the Client Wealth Management team here at Gluskin Sheff. On behalf of all my colleagues here in the room and those still working busily for you in the office, I'd like to welcome you here to our special event, a meeting of the macro minds. You know, as one of the leading wealth management firms in Canada, we focus on providing our clients with a way to enhance their wealth and enhance their knowledge. And one of the ways we do that is having these exclusive events like the one we have tonight. Tonight, we are all joined by the top economists in Canada, led by our renowned chief economist, David Rosenberg. The genesis of this event started with a conversation. David and I were boarding a flight in Denver, actually, and we were brainstorming about how can we get some of our greatest minds here in Canada to talk about the economy and make it impactful in terms of advice, insight to you. And lo and behold, what has happened? We've got an all-star lineup and over 300 guests here in the room. So it's been terrific. The incredible attendance is certainly telling us something about the seriousness of today's environment with respect to the challenges that are out there and the thirst of knowledge that you have towards helping you expand your wealth and understanding what's going on in the environment. So whether it's to understand what's specifically happening in your portfolios or even to better manage your businesses, I think this is going to be a helpful discussion for you. There's so much to talk about, whether it's NAFTA, some of the fiscal policies in Canada and the US, et cetera. So I think we'll have a great, robust discussion. The agenda for tonight will be as follows. Firstly, our David Rosenberg will wear a different hat than he normally wears, and it's going to be as moderator of this esteemed panel that we have. David will lead the discussion on a wide range of issues related to the Canadian economy. Given how rare it is to be able to get all of you on one stage tonight, which rarely happens, we're going to have a real fulsome discussion and make sure everyone's thoughts and opinions are shared with us as a group and have a little bit more of a limited and brief Q&A discussion. After the Q&A period, my colleague and our co-chief investment officer and head of equities, Peter Mann, will be joining us on the stage. Peter will provide some insight in terms of how we're actually managing our portfolios in this period of renewed volatility, and particularly based on the macro discussion we're having here. And we plan to wrap up this event sharply at 8 o'clock, and so there'll be plenty of time to have this discussion and then also to talk to you afterwards. So at this time, without further ado, I'd like to turn it over to our moderator, David Rosenberg.
Well, good evening, everybody. You know, when Jim came to me about 2 weeks ago and said that the demand was so high that we had to move it to the Four Seasons and over 300 attendees, my question back to him was, what happened to all the snowbirds? Might say something about the Canadian dollar, I'm not sure. But anyway, I do want to say and echo Jim's comments that I am just so delighted that all of you could come here tonight. And I think it tells me maybe two things on two different levels. As Jim had mentioned, I think it does tell me to a certain degree the amount of curiosity and concern that we have over the Canadian outlook right now. I'm not going to say that, you know, we're at the, you know, the crosshairs or some existential moment, but it does seem to me as though we're at some sort of inflection point in many respects, and we're going to talk about that today. You know, whether it reflects, you know, the fact that Ottawa is adrift on fiscal policy, the fact that we can't sell our own oil or because there's no pipeline capacity, and basically a totally inert federal government policy when it comes to energy. You know, we have the NAFTA uncertainties, and then we have trade wars of our own making between Alberta and British Columbia. And then June 7th, we have an election in Ontario where it's just hard to believe Kathleen Wynne against Doug Ford. I guess that's our own domestic version of Hillary versus Donald. And so there's really, when you think about it, you know, no shortage of complexities right now. And so in that respect, I can understand why we want to come here tonight and hear really from the best macro minds on Bay Street. And I've known these people for a long period of time. And I think there's a wide recognition here that, that we do have on stage really the top economists. And I'm really thrilled that they also were able to come here. I always like to say, you get 5 economists here, we'll be lucky to get 10 opinions. But that aside, I actually added up, this is what I do for fun with my Hewlett-Packard calculator, that I added up all the years that we've been on Bay Street as economists, and it comes to 140 years. And as Doug Porter said to me, 75 of those are my own. So as Jim had mentioned, we have a certain structure to this evening because, we get all these economists in, and I was thinking, boy, it'll be a miracle if we're not ordering pizza at 11 o'clock tonight. So we're going to cover 5 broad topics, and there's going to be a lot of, obviously, commingling with other topics on top of these topics. But to keep it structured, what I did was assign each one of these economists to a certain issue. So, for example, Doug Porter over here from the Bank of Montreal is going to cover NAFTA and trade, and Ben Tull from CIBC is going to cover housing, and we've got Craig Wright from the Royal Bank who's going to cover fiscal issues, and Francis Donald from Manulife who's going to cover the Bank Canada, and David Doyle, last but not least, is going to cover the topic I first introduced, which is the Canadian dollar. And of course, everything we're talking about tonight is going to have some influence on that. So what we're going to do is I'm going to probe each one of these economists for 3-4 minutes, give their outlook on the particular file, and then open up for discussion and debate. Now, I know that some of you had said to me, well, are we going to get into a fight? Come on, we're economists. But, if it does turn into a school fight, I brought my school bell. So, and that's basically to make sure that we all stay on time, to be respectful of your time. And so after that, I think I'm going to ask each one of the economists to give their one out-of-the-box unique forecast for the coming year, maybe the coming 2 years, the one forecast that sets them apart from the pack. We'll open it up for some Q&A. That'll be, I think, limited time frame. And then, as Jim had mentioned, Pete Mann will come in and tie in how we're finding opportunities in these uncertain, tumultuous times. So I'm going to lead off with Doug Porter. And Doug, your team and yourself wrote the seminal report on NAFTA late last year. And I'm not going to ask you to talk about the overall macro effects. I think you had found that over 5 years, the overall GDP impact was going to be relatively small. But looking at the overall economy, when you say the overall average is going to be small, I mean, the average, this is the average. The average is that, your head's on fire and your feet is a block of ice and your temperature's just fine. But, you've got 2 different things going on. So I'd like you to focus on, A, is the abrogation of NAFTA your base case scenario? Point number 1. How are you handicapping those odds? And then if NAFTA is abrogated, because everybody here is an investor, is, which are the industries that will be most negatively affected and which regions? And then which parts of the economy wouldn't be affected as much? So take it away.
Okay, easy stuff, thank you. And good evening, everyone. A pleasure to be here. Thanks for the invite. So since I'm talking about trade, I'm just going to wing this and make up the facts as I go along, since that seems to be the way to handle these things, at least according to the President of the United States. Actually, it's interesting. Today, Mr. Trudeau gave an interview where he said that he thinks that Trump is quite enthusiastic about getting a deal on NAFTA, and I never thought I'd see those 3 words in the same sentence, Trump, NAFTA, enthusiastic. I actually do believe that the U.S. is serious about getting a deal. Of course, they want to get a deal on their terms, but I do believe they're serious. Of course, the issue is, of course, going to be getting from here to there, and I still think there's a huge hurdle to get there. To answer your first question, we're not assuming that NAFTA will be terminated. I think even in the worst case, even if Mr. Trump did decide to try to terminate it, I don't believe Congress would fully play along, and we'd probably be in a world of zombie NAFTA, where and we've seen this before on certain contentious issues where basically Trump throws it back to Congress and then nothing really happens. And I could see that in sort of a worst case scenario in NAFTA. But I think what's more likely is that the politically incredibly tight timetable means that we're probably not going to get anything done by mid-year, and then it gets dragged out. And in many ways, this is exactly what President Trump wants. He wants the uncertainty that forces companies to, if they're choosing between Thunder Bay and Peoria, to locate in Peoria. In many respects, the uncertainty in a zombie or quasi-zombie NAFTA really suits Trump to a T. That's really what he wants to achieve. He wants jobs and investment back in the U.S. and not in Canada or Mexico. In terms of who would be hurt if NAFTA were to be terminated, our report laid it out in gory detail, which regions would be most affected, and we think there's really no debate about it. Ontario would be hardest hit, both because of which industries we're involved in and of course, the reality that we do the most and are most exposed to the U.S. in any event. And then our next two neighbors would be the most affected after Ontario, Manitoba, and Quebec, and then it really does slide off as you move away from the middle of the country. In terms of industries, well, first of all, we do not know because we don't know who would really be affected by special trade protectionist measures if we didn't have the protection of NAFTA. But we're assuming it would be things like the transportation industry, the transportation equipment, I should say, the tech industry, machinery, a lot of basically durable manufacturing we think would be affected the most. And I'm sorry, I forgot your middle question. I gave the bookend answers.
Well, it's irrelevant now because it's not part of your base case scenario.
Right.
But I actually asked you to handicap it. But
yeah, that's right. And I would at this point, and of course it changes by the day. It really does ebb and flow in terms of what we think is most likely to happen. I would say I'm actually a little less negative on NAFTA than I would have been about a month ago or so. I think probably the most likely scenario is this sort of middle of the road zombie NAFTA where really nothing happens. I think the chances of some kind of a deal have increased. It might be almost a stopgap measure where we have a NAFTA light deal that basically tides us over through the political uncertainties of the next 9 months, and then we have a more serious effort after 2009, after the midterm elections, I should say. But in terms of handicap, I would give it about a 50% chance of a zombie NAFTA, about 20 to 30% chance of a deal, and 20 to 30% chance of some kind of abrogation.
Okay. Well, it sounds like it's just lingering uncertainty, which is going to hold back capital investment. But panel, strong agreement, disagreement, anybody?
Well, I think that, I'm losing sleep over NAFTA. I think that when it comes to NAFTA, we are in la la land. I think that this zombie scenario is a disaster. That's exactly what Trump wants. And it's going to be a major issue because you are a CEO of a company. What do? You don't invest. Already the tax system is against you. Money is going to the US, and now you have NAFTA. So you're not going to establish anything in Canada. Everything will go to the US. You are a CEO. You need clarity, and you don't have anything. And this will continue until 2019. So to me, this means that the Canadian market will underperform the US market in a big way, simply because of the fact that this fog of uncertainty is not going anywhere.
Well, let me ask one of you three folks. Let's say Doug is right that we reach a deal, or even a zombie deal. It seems to me as though the only way we reach a deal is if we acquiesce and capitulate. So the question would be, under that scenario, like, what are the odds of that happening? What are the odds of the Trudeau government going back and saying, okay, we will actually acquiesce on whether it's, supply management or rules of origin. Like, there's some of the things that Trump is asking for would exact this high degree of pain, especially in the auto sector, even if we end up reviving NAFTA in a different form. What do you think?
There's a part B to your question, which is, what is the currency offset that occurs after that? So we receive this big piece of negative news, and then how much does the currency depreciate and provide us some relief from that situation? That's one of the reasons why a lot of the simulations performed by these three gentlemen and their departments show minimal effects over the long run. It's because we get this offsetting currency effect. It's the same thing that happened when oil prices started to fall. The currency fell off a cliff, and we had this little cushion moving forward. So the bigger question to me is, how much cushion do we get following following that negative type of scenario. That's the key determinant to how painful it is.
Yeah, I get that, but I would say that the currency's impact on the economy happens with like long and variable lags. The impact you'll have on business investment and exports will be pretty immediate. Craig, any thoughts?
Yeah, I think the government, our government, is showing some flexibility on those so-called 5 poison pills. And when you look through them, you know, the sunset clause, renegotiating this every 5 years, that makes no sense. But you can rework it, so you just revisit it, tweak it, or refresh it every 5 years. Rules of origin, you know, if they look at a broader definition of what content goes into an auto in terms of some of the technology and components that go into it, we're not too far off of the number, the 85% he's looking for in North America. The 50 from a U.S. specific is a little bit more of a challenge. Supply management, you know, for some political regions is going to be very difficult. But when you look at, you know, how many people are employed in that industry, it is those industries that are protected are very small. So there are room for flexibility on that. And I think we've shown some comfort. To Francis' point and a bit on Doug is, we all get a modest impact because we assume, you know, NAFTA gets torn up, we revert to WTO. And in WTO, about 50% of Canadian exports have no tariff, and 25% of Canadian exports to U.S. would have tariffs less than 2%. So we can live in that world. But who we're dealing with, what if he decides WTO doesn't stand, and then it gets ugly fast, and you know, you can file complaints in WTO, but they take years, so then it's countervailing. Everybody else jumps on board, and we get the trade war, which is the big downside.
Yeah, well, you know, I think it's actually less about the tariffs and more about why we wanted free trade to begin with before NAFTA, which was the security of the U.S. market, the certainty aspect. All right. So I guess, I don't know, David Doyle, do you want a few seconds?
I would just say, I just signed a relatively low probability to an agreement. I don't think that the Trudeau government can move far enough towards what the Trump administration is demanding on this deal and still achieve a deal that's domestically saleable here. So in order to get agreement, you need to move so far towards what they're demanding that in turn you're shooting yourself in the foot domestically. So I actually see them being incentivized in much the same way as the comment was made about the Trump administration. They're incentivized to drag this out and maybe drag it out as far as 2020, 2021, and hope you get a new administration in place.
So Dave, how do you trade this? How do you trade this? Well, first of all, you short the Canadian dollar, and the dollar is moving the right way, and it will continue, I believe. Second, you definitely short the Mexican peso. I have no idea why the Mexican peso is at current level. And to me, that's mispricing in a big way. So that's the way I will trade it, at least in the short term.
And well, especially because the prospect they get an anti-business government on July the 1st is pretty high. Okay, so let's move on to motherhood, otherwise known as housing. Okay, show of hands, how many people in the crowd are in the real estate business? You see, what did I tell you? So, you know, Ben has written a lot on the housing market for years. We have him in our office fairly regularly to give us updates. And, you know, we've got these, these B20 guidelines that are going to basically affect housing affordability. They brought forward a lot of housing consumption in the last year. We're starting to see the last number of data points on sales and prices, especially here, have been exceptionally weak, especially on single family. So I'm gonna give you a bit of carte blanche to talk about the housing market. I want you to keep it focused on the GTA. When we take this on the road to Vancouver, you can talk about Vancouver. But GTA, and just talk about, basically, what's your view for the next year and maybe your long-term view? And I think principally what people are most concerned about are where house prices are going. So if you can address that as best as you can. You don't have to get into the neighborhood. I think my neighborhood on Brookdale Avenue is pretty sheltered. But tell the crowd what some of the risks are and how deep the housing price correction can go on a near-term basis. And on top of that, what house price decline, and I guess this would be more nationwide, but what would get you more worried about delinquency and default risks that could end up having an impact on bank earnings?
Yeah, you're right. It's the GTA in Vancouver. Let's face it, all the rest is not interesting. So the GTA, we're talking about the GTA plus, we're talking about Hamilton, Kitchener, Barrie, because, you have people that drive until you qualify. It's, there's the Toronto refugees that go there. That's why when you talk about correlation between those centers and Toronto, it's basically 95% correlation. So it's not just the GTA, it's much more than that. Same goes for Vancouver. Now, listen, until 2016, when it comes to the GTA, I was able to explain everything. I have all those models that try to explain the housing market, in terms of demographics, demand, supply, and all my models were able to explain most of it. Something happened in 2016 that all my brilliant models were not able to explain. And if I cannot explain something, it must be bad. So I'm sure it was speculations. I'm sure it was flipping. I'm saying something bad happened in 2016 in the GTA in the first half of 2017, the way it happened in 2015 in Vancouver. And usually when you have something like this happening and activity goes up by 20, 25%, as you know, in 2016 and the first half of 2017, usually gravity takes place. And that's exactly what happened in 2017. And exactly at this point, we have seen also the provincial government introducing the 16-point program that most of it really is not relevant because 14 out of the 16 they simply cannot implement, so it's not important. The rest, some of it, unfortunately, was misguided. Rent control was very misguided. But in any case, we'll talk about it later, maybe if we have time. But this is the correction. The correction is clearly gravity plus policy plus changes by OSFI. So we are talking about a situation in which the market is adjusting. And what we are doing now in the GTA, we are simply undoing 2016 and the first half of 2017. That's what we are doing. Not more than that. We are simply undoing it. Because people say, yes, low rise, single family down by 11%. It was half by 16% 6 months before that. So we are undoing it. And that's fine. We haven't seen any adjustment in the high rise because, again, when you have an affordability crisis, you have a situation in which people go to where they can afford, and that's actually the condo market. So the condo market is a stabilizer here when you look at the overall situation. So talk about numbers. I don't know. I think that when I talk to developers of new construction in low rise, we are seeing a very interesting situation. Demand is definitely slower than it used to be. They're not used to it. But the small developers, mid-sized developers, they can simply stop. They are all loaded. They're all rich. They don't need the money. So they basically can stop. And that's what they're doing. So we are seeing supply going down, actually. And the only companies that continue to build, those are the large ones that have, an engine that has to continue to go because they have a stable labor force, and they are actually lowering prices. The others actually lower prices, and then they stop releasing, so supply is going down. That will be a mechanism that actually will ease the pain. In the resale market, we're seeing more supply, less demand. The market is adjusting. Can it go another 5-7% down? Absolutely, it can in the low end of the low rise.
Single family? Single
family over the next year. But I think that the vast majority of the decline is already there. We'll see a little bit more, and that's it. This is not a free fall by any stretch of the imagination. The high-rise segment of the market, I think we have seen 36,000 sales last year. This is crazy. Usually we sell 22. We got 36. That's a very, very strong market. There is a lot of supply in the pipeline. I will not be surprised if this market will soften a little bit, especially with foreign investors slowing down. But I believe that with B20, a bit increase in interest rates, and of course the gravity forces, we will see some softening also in the high rise over the next year, year and a half. But this is just the short-term story. The long-term story is that this city is becoming more and more expensive. This is just a slowdown in a trajectory. And this, in the GTA, it's all about policy. We simply don't have enough supply. Toronto is an island when it comes to real estate because of policies. We don't have land because of policies. The Places to Grow Act, introduced in 2006, is the main reason why prices in the GTA went up. All the other is the gravy, low interest rates, demographics, we know the story. But the lack of supply is definitely there. And policies to date are making the situation even worse. I'm talking about the changes in the Ontario Municipal Board. I'm talking about rent control. This will make the situation even worse. So yes, from a short-term perspective, the next year or two, am I going to invest in real estate? Maybe not. But from a long-term perspective, if you believe that this city is unaffordable now, you wait.
Well, how does the Ontario election? I mean, because you're assuming policy is going to remain the same. What if Doug Ford wins the election? What would that do to supply?
Well, Doug has been relatively quiet on housing. I did speak with the chief of staff, and they are going to revisit a few things according to what they're telling me, but who knows. I think that rent control is a major, major issue. And when I say rent control, I'm not saying that rent control is a bad thing. Although, when I wrote about it, I quoted a Swedish economist, a left-wing economist, a Swedish economist saying, rent control is the best way to destroy a city, maybe besides bombing. And you know what? He's right. This is not a smart policy. And I was begging the government to basically go with inflation +2, namely rent increase of inflation +2. By doing so, you protect the tenants, but also you allow builders to build purpose-built rental that we need desperately. And now we don't have it, and that's why supply will be a major issue. So if we are able to revise that, that will be great. If we are able to revise the decision about the Ontario Municipal Board, that will be great. Much more important is simply releasing more land, or at least accelerating the process in which land is being released to the market.
Yeah. So you said single-family GTA 5 to 7% down. We're already down 17% in the past year. Most of that correction is over. That's your view. Condos, though, you didn't give me a number, Ben. Give me a range.
Well, I don't know. I think that the way I see it, the condo market will be stable to -5, 6, and then it probably will go up a bit. So it can go down a little bit over the next year or two, but nothing to write home about.
Okay. Well, okay. Sounds pretty bullish to me. Okay, panel. Anybody?
I know you wanted GTA, but Vancouver was a bit of an example for us. And when Benny's talking about what changed in 2016, we know policies in Vancouver changed. Some of that hot money probably migrated, and post changes in Ontario, people are looking at other cities like Montreal. But if you look at what we've seen over the number of years is all this macroprudential tightening at the federal level, some at the provinces. So it's all demand management. And to the extent it's a supply challenge, we don't have enough work on the supply side. To Benny's point, we need the municipalities to start getting more builder-friendly, if you will, release more supply. And until then, I see Toronto prices leveling out where we were year over year at 3.5%. I see pick up much like what we saw in Vancouver. Vancouver went from 33 to 8, and now it's at 16.5. And Toronto was 31, now it's down 3.5. And I suspect unless we see more supply, Toronto prices will firm this year.
I'm not exactly a Pollyanna of the housing market because there are some challenges. One of them, which is very, very important, is domestic investors. People talk about foreign investors. I'm not interested. I don't think it's important. I think it's the media. It's not really important. It's like 5% of the market. Domestic money is important, but that's new immigrants. So taxing foreign investors is not a big deal, in my opinion. I think that much more important is domestic investors in the condo space. Today, if you include principal payments, and I will be releasing a paper on that soon, no less than 50% of those domestic investors in condos, 50%, half of them, are already in negative cash flow. They're losing money on this investment. So the question is why? Take a GIC, get 2%. So maybe they think like me, that from a long-term perspective, that will continue to go up, and that will be a good investment, and their kids will be able to afford living in this city. So that's, if you want to understand the real estate market today, you must understand the psyche of condo investors. They account for 50% of the market at this point. 50%. And if they start selling, if they stop buying, this market will go down. So that's the key wild card, if you will.
Well, I guess that's the real question is, I mean, you've already established what the supply curve looks like. But, the question is, have we reached such an unaffordable state? And you talked before about the GTA becoming so expensive. We talk about the solid demographics in the GTA. But when you extrapolate that in the future, when you look at tax rates in Toronto against where tax rates are, say, in New York, there's almost a 10 percentage point differential rate right now. And under this tax regime, will we attract the people into this? Because really, I mean, you talk about the domestic investors, but at the margin, the foreign investors matters a lot too. So I don't know. I think that big risk is going to be demand erosion. And the thing we know is that house prices have a lot of correlation, a lot of their own correlation. Like they build on momentum. Anyway, Doug, I saw you shaking your head, so.
So it's funny, I actually agree with a lot of Benny's conclusions. I just totally disagree on how we get there. First of all...
Okay, well, then nobody really cares.
Yeah, that's true.
That's all that matters.
Just two quick things. On the supply issue, we always hear supply, supply, supply. Last year, we had over 220,000 starts. Vancouver starts are at close to all-time highs. Toronto starts are very, very high. It takes a while to actually complete some of these units. I actually think that's totally exaggerated. I think we obviously had pure speculation, and yes, a lot of it, especially at the upper end, was foreign investors. And what is the one, you didn't actually mention, what the one measure of the 16 that the Ontario government brought in that actually made a difference? It was the non-resident buyer's tax. Lo and behold, that's exactly when markets peaked, and it's been straight down for the detached market since that day at the margin.
But the condo market's hung in remarkably well.
And that's because that's not where the foreign investor was buying. They're buying in the detached market.
So let's talk about this supply business. It's true that the number is 200 and something, 12, but look at the composition. You know, in fact, if we didn't have this change, prices would have been much higher. Think of it. Since 2000, for every unit decline in what we call low-rise, we had 1 unit increase in high-rise. So we're basically building less and less and less low-rise, single detached, and building more and more apartments, which means that 1-to-1, the ratio is 1-to-1 basically. You are replacing an expensive unit, a house, with an apartment, less expensive. In a funny way, this actually limited the price inflation in the GTA. Can you imagine if we didn't have this substitution? So we're definitely changing. I totally agree that the issue is not supply. The issue is supply given preferences. Namely, everybody here still wants to live in a house as opposed to an apartment. And people haven't changed this way of thinking. Also, we haven't graduated to a situation in which if you are 35 years old, you are married, you have 2 kids, and you are renting, nothing is wrong with you. We haven't graduated to this, like in London, like in New York, like in Berlin. So the only way to solve this crisis is to release the rental solution. We have to change the way people think, but much more important, we have to have supply, and with rent control, you will not have the supply.
This side of the panel has been relatively quiet. Going once, going twice.
I'd add that I don't see supply as being a major challenge. I'd echo what Doug said. Everyone talks about how the U.S. went through an overbuilding phase from 2001 through about 2006. They were averaging something like 2 million or 2.1 million housing starts per year. Well, if you just do a crude approximation to Canada, that's the same as 210,000 or so. And we've been doing that not just for the past 5 or 6 years, but you X out the financial crisis of 08-09, and it's almost 12 to 15 years. And now part of that is making up for an underbuild that we had in the 90s. But I think now we've entered a phase where supply on the national level is starting to outstrip what underlying demand growth is. And that puts us in a dangerous position, in my view, because if ever we do suffer, another recession or a global recession, and it might not be that far away, we're going to be very, very vulnerable because of that overbuild phase that we're going through right now.
You know, when I was talking about this when I was at Merrill in the last cycle, when people called me the skunk at the picnic, it wasn't rocket science. I just reverted to Bob Farrell's rule number 1, which is that markets and ratios revert to the mean over time. And I have a tough time believing when I look at home price to rent ratios and I look at housing valuation to income ratios, those charts don't look like they've really mean reverted just yet. Question I have, and I'm going to come back to you, but keep it tight so that we can get on to the next issue, is let's say you're right that it's 5 to 7%. Let's say it's 7 to 10%. Who is vulnerable on the financial side? The banks, the non-banks? Like basically, it seems to me that you have a lot of leverage in the system, right? You probably have a lot of people. You go down 5%, you're in a negative equity position. And the question is, do you default or not? I mean, as we saw in Ontario back in the late 80s. So what's your big concern if home prices were to go down further than you think?
First of all, I think that, listen, the cycle is not dead. There will be a recession. You probably will say the recession is coming in 2 years, maybe. And when there is a recession...
Hey, I'm moderating this.
When there is a recession, the housing market will correct. My point about the supply and the fact that it's tight is from a long-term perspective. It's not the next year or 2 or 3, because things can happen, and they're happening now. So am I investing in real estate now? Maybe not. But if you ask me if I'm investing in real estate for the next 10, 15 years, absolutely in the GTA. Because you know what? What is high? Relative to Vancouver, we are cheap. And Vancouver is coming up with all kinds of tricks how to afford this. People don't really know much about it. But if you look at residents in Vancouver, 1/3 of them, people living in single detached house, have a tenant. In Toronto, it's only 10%, on its way to 30%. So there are all kinds of tricks to find affordability. So from a long-term perspective, I think that Toronto can go places, although totally agree that if tomorrow there is a recession, the housing market definitely will correct, and I will be buying into this correction. Now, in terms of who is more vulnerable, I don't think that higher interest rates will lead to a wave of defaults like in the US. I think it will lead to a situation in which more money will be going towards debt financing, less towards consumption, and potentially that can be recessionary, and that can lead to higher unemployment and therefore higher delinquency rates. So it will be in the back door. It's not the impact of higher interest rates, at least not the immediate impact. So clearly, if it's a very severe recession, then we'll feel it, and the risk is actually a recession coming from the US, so that's definitely a risk facing the housing market in Canada.
Okay, I gotta add one little thing here. I'm not talking because I have a personal bias that clouds my view here, which is I'm a renter. I might be the only one in this room. Okay, so I don't know, Ben, if you were just intentionally describing my situation earlier and my demographic. 1/3 of Canadians are renters. And I'm gonna do something I never do, which is I'm gonna tell you a personal anecdote, which is not how we run economic analysis. I went to go see 3 houses this month, 3 rentals, and I entered into a bidding war for each one on the day of, a bidding war for a rental. That's terrifying to me. So 1/3 of Canadians, renters, okay? Number 2, do you know what the number 2 determinant of fertility rates are? House prices. Number 1 is female education. Number 2, house prices. Because if you cannot afford...
I thought one might have been NHL playoff season, but...
Well, my son is 6 months old. It's actually the Raptors. So number 1 determinant, female education. Number 2, house prices. If you cannot afford another bedroom, you are not having more children. So I think we need to think a little bit more broadly about what the long-term ramifications of this situation are. And if we are heading towards a situation that is being described here, that there will be offshoots that affect our broader economy on a longer term run than just what's going to happen to 5 or 10% moving forward.
All right, well, that was a lot of information. I want to spend maybe just 1 minute on this, okay, as an adjunct. Just, is there any concern about, I know that you were quoted in the Globe and Mail about that you weren't that concerned. Household balance sheets in Canada. Concern, not a concern, constraint on growth, no. Okay, so no concern about consumer balance sheets.
The only thing I'll say that the BIS came up with this thing saying that we are going to explode tomorrow. The BIS. So I said my answer: remove the middle letter.
Mind you, your own group said a couple of years ago that the debt levels in the household sector were going to be a critical constraint on interest rates. Correct? I remember reading that. Wasn't you, it was Avery.
No, what we are saying, which is very important, is that there is an increased sensitivity to higher rates. There is no question about it. As a society, we're definitely more sensitive to the risk of higher interest rates. Low interest rates, when they went down, they really didn't impact the market in any significant way because we have a generation of Canadians that never experienced high or even rising interest rates. For them, those extremely low mortgage rates, it was not as exciting, yeah? It's like, interest rates, it's like being in a relationship. In the first few weeks, you're so excited you cannot breathe. But if after 5 years you cannot breathe, you have asthma. Yeah? so what I'm telling you is,
or you go rent. Okay, we're gonna move.
The point is that what you're saying is that what Paulus is telling us. He's telling us maybe the disease is also the cure. Maybe the disease is also the cure. Namely, the increased sensitivity to higher rates will prevent interest rates from rising to the sky. That's the point.
Okay. We're going to move on to item number 3, which we're all in complete trepidation with Joe Oliver in the crowd, so we should watch our step here. So look, I want to talk about, I mentioned at the outset this what I call a policy drift in Ottawa. Then again, you can say that the Trudeau government is just carrying out what they campaigned on. I don't know what grade you would give the last federal budget in February. I don't know if I would even give it a passing grade, but the one thing that I was happy about for Canada, basically, was that at least they walked back from a lot of the radical measures on the taxation of that passive business income from the trial balloons that they floated back in July. But, you know, they had, they had a couple of months to assess the U.S. tax cuts, right? Like, do we operate, I would ask the group, the crowd, do we operate in some sort of a vacuum? That we have like a few months to prepare. This is basically, like, think of this budget, right? 369 pages. This is page 296. This is the only mention of what happened in the U.S., which, by the way, you told me at lunch was a game changer for Canada. One sentence. Over the coming months, the Department of Finance will conduct detailed analysis of the U.S. federal tax reforms to assess any potential impacts on Canada. Thanks for coming out. This is what gives civil servants a bad name, don't you think? The reality is that we've already had 3 populist budgets in a row. And of course I'm going to ask Craig Wright, who's an expert on fiscal policy, and of course, you know, the Royal Bank's got a lot of contacts in Ottawa. We have one more kick at the can. There'll be a budget next year, so let's not talk about this last budget. But what do you think, will we be talking about a year from now, they finally get it, we've actually got a competitiveness budget, they're going to address the fact that, if you're a corporation right now, we're talking about Toronto home prices, where are you going to locate your business right now? For the first time in decades, the net effective tax rate in the US is lower than it is in Canada. We've lost a huge competitive advantage. And one sentence in the budget 3 months later. So I guess the question I was asking you is, what's the bank and what's your role going to be, and what will you advise the federal government going to next year's budget? And do you think that next year we will shift away from populism towards competitiveness, in your opinion? This is going to be right before the next election. What are your thoughts?
Thanks.
I just dinged myself.
Yeah. So I know former finance minister in the audience, so I'll be careful, but I think we see eye to eye on a few issues. We do have contacts at finance, but they're not allowed to talk to me anymore because I'm considered a fiscal hawk. And a fiscal hawk in this environment is somebody that wants a balanced budget at some point in your lifetime. And that's where we're at. So we had a minister many years ago, a liberal finance minister, who wrote a book, I think it's called Balance the Budget Come Hell or High Water, and now we're going to run deficits come hell or high water. So right now, the focus on redistribution, not growth, and the point, and we do these meetings with finance ministers a couple times a year, and the rules of engagement are you can say what you say, you can't say what anybody else said, and I know others have been in these meetings as well, so I'll leave it to them to comment. But so I think you're being generous that they had 3 months to look at this. This was something that myself and others mentioned a year ago in the last run-up to the last budget, because Trump came in on a platform that looked pretty likely that he was going to cut personal taxes, cut corporate taxes, lighter regulatory touch, and lighter carbon touch. And so we're warning, saying competitiveness challenge, let's get in front of this and not react to it. And then a year later, the U.S. didn't do anything, but we still saw an erosion of our competitiveness because we raised corporate taxes, raised personal taxes, and carbon pricing has been a cash cow for the provinces. And then we got some minimum wage issues in that too. So this year, it's sort of from the existential debate to the reality. And he's made all these changes, and it was pretty much radio silence in terms of looking at it. So as we go forward, the challenge is if you're committed to spending, you don't have room for a competitiveness budget because it's going to cost you tax dollars. So I'm not very bullish on a competitiveness budget as we go forward. And when you look at the relative competitiveness, you can look at a number of different indicators, but foreign direct investment into Canada in the fourth quarter last year was levels we have not seen since the global financial crisis. So people aren't investing here. Foreign Canadian investment outside of Canada is almost at a record high. I was out west last week and a client said to me, everybody talks about the world needs more Canada. Well, they're going to get it because everybody's moving. And I mean, that's a bit of an extreme view, but you're looking at the foreign direct investment numbers. Inflows are down, outflows are rising. You look at some of the business surveys. We do a Bloomberg survey, look at 4,000 companies, their investment intentions. Bit of a bounce in 17 after really 2 tough years. And then 2018, it's a 3% gain, and 2019, it's a 3% decline, so basically flat. Stats Canada is a CapEx survey, same kind of story, very weak. It's not all energy, it's non-energy as well, and maybe this to Benny's point and Doug's point about, Trump maybe winning by not even doing anything just because of that uncertainty. The only sign of optimism in the Business Outlook survey of the Bank of Canada, it's 100 firms across industry by size, by region, and it showed Q1 high, 2 came off, 3 came off as NAFTA uncertainty elevated. And then Q4 printed surprisingly high. So maybe it's some optimism there. We'll get an update in April 9th. But that's machinery equipment investment. So that's kind of, fix and repair, not build and grow. And so I'd be more bullish if we saw some of these other investment numbers turn around. And I think the challenge is it's a commitment to spending. We saw that with the last budget. The infrastructure program got pushed out. We had better numbers on the growth side. So they had about a $10 billion room to play, could have booked a lower deficit, set you on a better path for a balance, and it was all spent. And that's the environment we're in, and as we go forward, that looks like the only benchmark that you mentioned, fiscal policy, I mean, it's unanchored. They target our debt to GDP, which you have no control over GDP, and it encouraged pro-cyclical behavior. So I know that Francis can talk about the Bank of Canada, but the bank last year did estimates, a 100-point rise takes growth down by a percentage point. Last year, federal government estimates they added half a point to GDP. The bank raised rates by 50 basis points. They're sucking and blowing in Ottawa. They're going in the wrong direction.
Yeah, but I just want to come back. You said that, that you can't spend more and cut taxes, but that's exactly what they're doing in the States. They are spending more, right? And that was the whole quid pro quo with Trump. And the spending bill may or may not get passed this week, but there's going to be more spending. They're cutting taxes. Their starting base on their deficit GDP ratio is higher than ours, and their federal net and gross debt GDP ratio is worse than ours. So, I mean, I said, do we operate in a vacuum? So I'm not pro-government spending, okay? At least not wasteful spending. But if the U.S. doesn't care about the deficit and they could finance it, are we going to be like holier than thou and we're going to focus on the deficit? Well, the U.S. isn't. The U.S. is spending, cutting taxes, and we're going to increase spending, but I don't see why there's any logic as to why we couldn't cut tax at the same time, so long as we can fund the deficits. Anyway, let me open it up for the group for any comments or what you're hearing.
Of course, in the U.S., it's front-loaded. They will pay for it heavily come 2019, 2020. We know that. But absolutely right. In the short term, I think that we are losing this game. As you know, the tax rate is basically the same corporate tax rate. They can repatriate money. If you are decide to establish your business in Canada, you're not sure whether or not you can actually ship your goods to the U.S. And as you all know, in the U.S. they don't have global warming. We do. So we pay carbon tax. But so I'm asking where the money is going, and that's why going back to the dollar, and you will talk about the dollar. What's the mechanism that will correct it? It must be a weaker loonie.
Well, okay, that's part of the part of what we're talking about tonight later on. But I guess the point I'm making is that, and you're probably right about the Canadian dollar, but you're a North American business, or you're a global business doing business in Canada, and all of a sudden you are incentivized for the first time to book your revenues in the United States. So the capital investment and the jobs, well, this is going to come down to your housing call, because we know what a fifth of the economy is in the GTA nationally. The one thing I didn't understand, and Craig, you didn't bring it up, was the simplest thing they could have done. Simplest thing that would have cost them nothing, which is the full year depreciation allowance. Why not just go there?
They're studying
it. Pardon me?
They're studying it.
Oh, they're studying it. That's what I mean. You see, that's exactly what I'm talking about. They're studying it. But I guess the question I would also have, because have you met Morneau and you've met Trudeau? You met both. Like, do you get a sense that is there a difference between Morneau you meet in private and the Morneau that you see in public?
Yeah. I mean, to me, this discussion goes back to when we had Chrétien and Martin, right? CEO, CFO. The CFO can't do something other than the CEO on side. So they're both on the same page on this, is my guess. And privately, he's engaging. Publicly, in front of a camera, less so. But I think he gets the issues.
He gets the issues, but he just wants to study them. Okay, so.
No, but I think that I think it's fair to say, and you know, I met Trudeau, and he cannot say two sentences without the term middle class in the middle. No, he does believe that that's the case, and I totally agree that we want to live the middle class. By the way, that's a totally different story. I think that this issue, jobs, that, by the way, Trump and Trudeau are trying to lift the middle class, this problem, by the way, this problem simply does not have a solution. That's the elephant in the room that no politician will ever admit. It simply does not have a solution. Those people in Michigan, they will be waiting. Those jobs are not coming back. But that's a different story. The point here is that we reach a point where we need to grow the pie. You cannot just reallocate the pie. And I totally agree that accelerated depreciation schedule would have been an easy thing to do.
Even, when you think about even cutting corporate taxes, I guess you can't do that in Canada. But what, Doug, corporate taxes account for what out of the total revenue base? Is that even 10%? No. Like, it would cost them next to nothing. It just seems as though it wouldn't be part of their populist strategy.
Well, I think that's exactly it. It's just not in their DNA. But I suspect they're going to realize they have no choice but to respond. And in terms of the deficit versus taxes, I totally come down on your side. Given the hand we've been dealt, I think we have no choice. And it's almost like spending is fixed. God forbid we actually try to trim government spending at this point. But I think, given, are we looking at, a bigger deficit and lower taxes? Yes, I would take that option at this point, because I don't think we have a lot of choice. We're going to get blown out of the water in terms of competitiveness if we don't respond. I've been on a number of, to put it politely, junkets where I go with the federal government and basically try to sell Canada to the rest of the world. And what's one of the biggest selling features in the past? It's always been our low corporate rate, and that's just been knocked out the door.
But let me ask, if we either get to a consensus or not, it's not necessary that we do, but do you think that they will actually cut corporate taxes in the next budget?
I think they will.
Do you think they will?
I think they might trim it a point.
And that's to get us in line with the U.S.
Or slightly below.
Any views over here?
So if you look at the combined corporate state with the Fed and provinces, it's a rounding error between the two now. And for Canada, a small economy, that's risk of having a thicker border with the U.S., I think we have to do a lot better than just sort of get a bit below them. I think we have to go further. And we can do that. And just on the spending side, it doesn't always have to be incremental government spending. Their government spend is $305 billion. If you take 5% of that out and reallocate it, that leaves spending flat, and it's $15 billion, which can go towards deficit reduction, tax cuts, or any number of issues. So I just don't like the green light on spending, because we see what that does, and we've got that now, and deficits are cool again. The example being set at the top of the House, and that's discouraging.
Okay. I hope they do. I just don't think they will, not in an election year. I don't think that's the kind of policy that they believe would get them reelected. They'd be much more inclined to send out another wave of child benefit checks or cut taxes for middle class. I think that's what they see as being their sweet spot. That's what they see as what would get them reelected. So unfortunately, I'm not as optimistic as my colleagues up here. I don't think that they will, David.
Well, if that's the case, they don't realize who creates the jobs in this country, but that'd be interesting. Okay, so we'll move on from fiscal policy to monetary policy. And I've actually, I found calling monetary policy in Canada to be very interesting ever since Stephen Poloz took over the helm. And the case in point is what's happened this year. We get what seems to be 2 blowout employment numbers in November and December, which now have proven to have been a slight aberration. There's no communication between the Bank of Canada and the markets. The markets lead the Bank of Canada. They price in the Bank of Canada tightening policy in January, and they raise rates. And then it seems to me that ever since that time, Stephen Poloz has had a case of, shall we say, buyer's remorse. So what I find fascinating, and I want you to comment on this, Francis, is why is it that the market, the futures market in Canada, is still priced for 2 Bank of Canada rate hikes this year? We've taken 1 out, but not the other 2, despite everything that Poloz has said. I mean, he gave a speech. When was that speech, Doug? In
last week?
No, the one in November is what keeps them up at night.
Oh, early December.
Yeah, early December.
Everything except NAFTA.
And NAFTA doesn't show up. That keeps them up at night, and then it shows up like 2 or 3 times in the press release. And then it's all been about downside risk to NAFTA, downside risk to housing, and all these lingering downside risks. Everybody in Canada starts talking about tight labor markets and no excess capacity. And the Bank of Canada comes out and talks about, just last week, that they have a new measure of capacity. I guess it's not a published number, but there's more spare capacity.
Like a number, they change it.
And they don't publish it. Yeah. And their new wage number is just over 2%, not close to 3%. But anyway, I'm just going to ding myself and hand it over to you, just to talk about, let me just say, the market's priced for 2. And this will come down to the Canadian dollar call as well, but also what happens, say, at the front end of the yield curve. The market's priced for 2 Bank of Canada rate hikes. Where do you line up? If it's not going to be 2, is it 0, 1, or 3 or 4?
So I officially have 1 in the forecast for July, with the risk that another one happens later this year. But let me help you out a little bit, okay? I'm going to give you a framework for thinking about the Bank of Canada. So this is an incredibly challenging central bank activity for any central bank in this current environment. You have an economy that grew gangbusters in 2017. It grew like an emerging market, over 4% in the first half of the year. So the Bank of Canada fell behind the curve, and everybody knew it, and everyone was telling them, you've got to change directions and start hiking, you're way behind the curve. They are now, with their pedal to the metal, heading into a ton of fog. They have to balance a very strong economy where capacity is eaten up and they're now in excess demand with an incredibly uncertain future. What is making this outlook very cloudy? There's really kind of 4 buckets in my mind. 1 is NAFTA, 2 is the housing outlook, 3 is what happens to rising minimum wages and how that affects investment. And then the 4th one is maybe the hardest of them all, which is what impact do those 3 prior rate hikes have on the total economy? And this is actually really, really challenging for any economist to measure. We know that 1/3 of Canadians have no debt. So higher interest rates might benefit them on margins. We know that different types of products respond differently to different interest rate increases. We know that it's probable that the response to the economy is not linear, that 1 rate hike has 1 effect and 3 has a totally different. So the Bank of Canada has no way to assess this situation, and yet they're running full steam ahead. I think that there are I'm going to say something maybe a little bit contentious. I'm not sure everyone will agree with me. I think there are generally 3 misconceptions about how Poloz operates, and this is coming from someone who spent most of their career sitting on a trading floor. Number 1 is that the Bank of Canada cares deeply about how NAFTA turns out. I think that's true, but in the near term, they're actually much more focused on what NAFTA means for business investment. Why? Because as Carolyn Wilkins told us, there are too many outcomes across too many timelines when it comes to NAFTA. If we have trouble discussing and coming to a consensus, they're having trouble assessing what the impact is. What they care about is what the drag on business investment is going to be over the next year to year and a half. And that's why they're shaving down their business investment forecasts. When they talk about NAFTA, they're really talking about business investment concerns moving forward. At least that's my interpretation. Number 2 misconception is that Governor Poloz always wants a weaker Canadian dollar. I don't believe this is true. This is a bias that markets tend to have about Governor Poloz. I think he recognizes, and he's told us on many occasions, my favorite metaphor from him, a weaker Canadian dollar. He always has food metaphors. A weaker Canadian dollar is icing on the cake. The actual cake is U.S. demand. So you tend to see that the Bank of Canada is comfortable with a Canadian dollar that fluctuates between 74 and 80 cents. What happens when the Canadian dollar falls too sharply, too rapidly? We get this, do you remember the cauliflower crisis? I do. I love cauliflower. You fry it up, you little barbecue sauce, anyways. The problem is that Canada imports a lot of stuff. We import 1/3 of our food, 2/3 of our machinery and equipment. When the Canadian dollar tanks, what do you hear? You hear a lot of businesses start talking about rising costs, which is exactly what happened in the beginning of 2016. Imports of machinery and equipment, again, a business investment indicator starts rolling over the cliff. So Governor Poloz recognizes that there are costs and benefits to the Canadian dollar. The third issue I have is the misconception that Governor Poloz is always trying to control market expectations. I don't think this is the case. I think we often misinterpret speeches that are geared towards households or businesses as being a way to move the market, even if they do. One of the best examples was last week. Governor Poloz gave a speech talking about excess slack in the economy, how we need to have more women, Indigenous workers, immigrants working in the economy, and that this would help lift the labor force. Bang on, totally true. But guess what? That's not an interest rate sensitive move. That's not something that monetary policy ultimately moves. And what happens? The market says Poloz is dovish and the Canadian dollar falls off. So I think what the Bank of Canada, are you going to ding me?
No.
Okay.
No, but you're...
I'm getting close. Okay, I'll finish. What is the Bank of Canada actually watching? Okay, I think they're watching two things.
But I'm close.
Okay, I'm going. Okay. They're watching potential GDP, and they're watching the output gap. How much excess demand do we have in the economy? And they're watching the neutral rate of interest, which is what they believe is the interest rate that is neither tightening or loosening in the economy. When Governor Poloz says he wants to remain accommodative, I really believe that he's looking for something below the neutral rate of interest, which they believe is something between 2.5% to 3%. Those are the two numbers he watches. I think one more can't move too much faster into this fog. I'm nervous. I'm just going to stop there.
It's okay. You know, I gave you more leeway than everybody else because you're a renter.
Yeah.
Now, I think I might have to rephrase the question. So, look, the Bank of Canada gave us two critical pieces of information. Like, I know, I don't think the bank's raising rates again this year. That's my forecast. But I know that if I had rate hikes in my forecast and the bank just gave me two pieces of information, which is that they have a different wage number than what's published, and it's 70 basis points below what we think it is. And they told us that there's more excess capacity in the economy than they thought before. So no matter what your Bank of Canada forecast was, if you didn't change it, why didn't you change it? Or maybe you didn't change it, but you changed the probabilities around that particular forecast. Mr. Porter.
Yeah, more like that. I think, and we've been saying 2 more hikes, both in the second half of the year, by the way, after we have a lot more information on NAFTA. But after that speech, and some of the numbers we've seen recently, I think the odds are definitely tilted to them doing less, not more. In terms of Poloz not wanting to control the market, I think that is not a debate at all. He doesn't care what the market thinks. I don't think he's at all interested in fine-tuning the market. In fact, sometimes I seriously believe he wants to mislead the market. Not kidding.
Well, why would he have raised rates in January when the market had fully priced it in? Like, he followed the market.
Oh, no, I think that basically, I think he had a very strong case to raise rates. And when you've got the lowest unemployment rate in 40 years, you've got a wage increase of higher than 3%. Core inflation is close to 2%. You've still got basically interest rates at emergency setting. No, I had no problem with that rate hike.
Okay, but Dave, you say he gave us this piece of information, there's more slack in the economy. He gave an almost identical speech in December, sandwiched between 2 rate hikes. Yeah. So this is my point, that we're taking everything extremely literally and not recognizing that some of these speeches are geared towards talking about structural factors.
So, first of all, let me disagree on the dollar bias. I think Poloz has an agenda, and the agenda is a weaker dollar. Of course, he will never admit that that's the case. In a speech, as you remember, he said, "We do not have a dollar agenda. The dollar is off the table." And I say it is never an official policy until somebody officially denies it. I do believe he has an agenda. I think that everything that he did over the past 5 years was designed to lower the value of the dollar. That's in his DNA. That's my belief. Remember that the first 2 moves, the 2 hikes, were basically undoing the insurance cuts during the oil crisis. So they basically really raised only once, and now they are actually probably going to stop because I don't think they have a case to raise again. And one more point about data is the output gap. The output gap is a function of labor force participation and productivity. Okay, we can measure labor force participation in demographics. Productivity, good luck. Nobody has a clue what our productivity is. Not in the US, not us, because they cannot measure it. I met with the guy that ran the productivity numbers in the US. He will not bet his paycheck how accurate those numbers are. This wave of innovations, it's impossible to capture. And we are talking about the output gap in decimal points. It's laughable. It's laughable. So we have to look at wages as telling us actually where we are in the cycle.
Nobody in this room knows what the output gap is, Ben. Okay, so we got to move on to, I think what everybody came here for, the Canadian dollar outlook.
No pressure.
Oh, that's like I mentioned the Montreal Canadiens to this crowd. But not anymore, though. Okay, so Mr. Doyle, and I want the panel to weigh in on their views, but looney's been, it's not just been against the U.S. dollar. As Doug Porter pointed out, I think in your weekly, that we're down even more against a basket of other currencies, including Mexico and including the UK, including sterling. So quickly, where's the Canadian dollar going from here, and at what sort of level?
Yeah, so we see it going weaker kind of all the way through the end of 2019. At that point, we've got it at $1.36 or 73 cents if you look at it the other way. And that's versus the US dollar. But relative to something like the euro, we actually see even greater downside. I actually think the Canadian dollar will go to all-time lows versus the euro by the end of 2019. And I think what we're in for kind of over the next, call it 18 to 30 months, is that Canada is going to be paying the price for what I call the hyper-leveraging cycle that we went through from 2001 through 2016, 2017. So that was very, very good for our growth over that time horizon. It's part of the reason why we outperformed through the financial crisis in 2008, 2009. But now it's effectively, it's time to pay the piper. And why is now the time to pay the piper? It's because interest rates are going to go up. And they've been going up. We've already had 3 hikes. As Francis said, we still don't have an appreciation for what the slowing effect of those hikes will be. We'll gain some appreciation of that later this year and into 2019. My research suggests that the 3 hikes we've had so far is already the most severe hiking cycle in over 20 years. And it relates to a couple of things, the indebtedness that the consumer has at the moment, but also the astonishing rise we've seen in the Government of Canada 5-year yield. Why does that matter so much? Well, the Government of Canada 5-year yield tells us what 5-year fixed mortgage rates are going to be about. And what we have now is, for the first time since 2007, we have the 5-year change in that 5-year yield turning positive, and it's positive somewhere between 40 to 60 basis points. So the people like myself who were fortunate enough to buy their house 5 years ago, we're now renewing at higher rates. That's a negative shock for the consumer. But this problem only becomes more intense as the years go on, particularly as we get into the back half of 2019 and into 2020. At that point, people could be renewing their mortgages at 100 to 150 basis points above what they first got them at. And the reason for that is that's when we lap Mr. Pelosi's rate cuts from 2015 in the analysis. So this is happening to an economy where, as my colleagues have suggested, we haven't seen alternative growth drivers emerge. Business investment remains weak. Exports are subdued outside of the energy sector. There's no alternative growth driver there to pick up the growth baton. Our economy has never been more reliant on housing investment. It's close to 8% of GDP. Interest rate hikes are going to hit housing. In fact, I think some of the weakness we're seeing now in existing home sales is partially due to the rates going up. And to give you some context on that, existing home sales volumes in the first quarter of this year will subtract about 70 basis points from GDP growth in Canada. And so that's just a taste, I think, of what's set to come later this year and into 2019. So the market's discounting 2 hikes from the Bank of Canada through the end of this year. I actually don't have an objection with that. I think they'll deliver 2 more hikes because I think this is their window. I think they might realize that their window for getting notches, for getting those hikes under their belts is closing, and it's closing fast. Because by the time we get to 2019 and we have a more fulsome picture as to what's going on with the consumer and with housing and the effect of the rate hikes, they'll be forced to back away, and much more strongly than Mr. Pelosi's speech. Yeah.
You don't rent, so.
Yeah.
Just what's your forecast on the Canadian dollar against?
So yeah, I mean, at the end of this year,
yeah.
it's not that much different. It's $1.32.75,
okay.
But we get much more bearish as you get out into 2019, where we've got $1.36.73.
Okay, we got to keep this quick. So, Francis, what about the Canadian dollar? I think you're bullish, right? You're bullish on the Canadian dollar?
Well, yes, and only because we have a very weak U.S. dollar outlook. If you want to play the Canadian dollar and this very negative narrative, which we agree with, we're more likely to play it against the euro or other currencies.
But the U.S. dollar is already down more than 10% over the past year.
I like a third leg down. I like another
so
third
we
leg
can go down,
negative.
but we can go down with the weak U.S. dollar. Okay, Craig?
Canadian dollar, 122 at the end of the year.
Bull.
Yeah.
Bull. Neutral. Ben?
Down. I think that when it was 80, we said it was too expensive. Now it's at 76. I think it can go down a few more cents.
You're going to hate me. Unchanged.
Unchanged. Okay, let me just just say, from my perspective, let's say the bank doesn't go, the Fed's going to go 3 or 4 times. These negative spreads widen out. That's a dead weight drag. On top of that, we have looser fiscal policy in the U.S., tighter monetary policy in the United States. And when I went to economics school, that always led to, well, a stronger exchange rate for the U.S. against Canada. The one thing that it comes down to competitiveness. We have a 3% current account deficit GDP ratio with a Canadian dollar that's, where is it now, 77 cents?
Just under.
Okay, so 3% current account. Non-energy export volumes in Canada have not changed in 4 years with a 10% decline on the Canadian dollar. So that really speaks to some underlying erosion. I'll just leave it there. I'm back to being the skunk of the picnic. Okay, so quickly, and then we're going to get to Q&A. Quickly, your most controversial, out-of-the-box, unique forecast for the coming year or two. Doug?
I'm glad you went beyond the next year. We think we're going to see negative interest rates in Canada in the next cycle. In the next downturn, for some of the reasons we were talking about before, I think Canada's very weak competitive position. I think we're going to get crushed in the next recession, and it's going to lead to negative rates. But that's not a call for the next year or two.
So we should, brush up on our Swiss or, okay.
Japanese.
S&P 500 earnings, I think 2019 is too optimistic. The market is discounting about 10% increase in earnings. I just don't see how we're going to get it. We got, in 2017, 10%, which was a very, very strong year. 2018, now, the market is expecting 14%, but 7 of it is basically just a tax cut. So it's basically 7 plus 7. I don't know how you can get 10% in 2019. So I think that the market is mispricing. That's my call.
Okay.
Canadian growth, we're in the low side of consensus, so I think we had G7 leading, so we're going from first to worst. We don't have much on the investment given these competitive challenges. Exports still sluggish, and the consumer pulling back a bit.
How cheery. Francis?
I think we're closer to the end of the U.S. cycle than many are pricing in. Huge fiscal push creates overheating. The Fed goes too fast, and we tip into a U.S. recession, or the odds of a recession go much higher by 2020-21.
2021. Okay, that's
when
okay,
I get
we don't have to take out the umbrella just yet. We'll just wait another year to do that. Okay, Mr. Doyle?
I have the U.S. 10-year Treasury yield going to 3.75%, so up close to another 100 basis points by the end of 2019. But the Canadian 10-year about 125 basis points below that. And the reason is that I think for a prolonged period, Canada's growth and economy will underperform the United States.
Wow. Okay. Well, that doesn't get me too excited about the Canadian dollar. Makes me excited about how we're positioned, though. So, that said, I am going to call upon Peter Mann, our co-CIO in charge of the equity department at Gluskin Sheff to talk about how we're investing on all these particular themes. So take it away, Peter.
Well, I have to say, when I came here tonight, I didn't think that fun would be the adjective that I would use. But to be honest with you, I have not been in a room with this many economists before in my life that are this sharp-witted, that are this entertaining. It was a really great night. Thank you all very much. We really, really enjoyed it. So I want to briefly touch on a little bit of how we're thinking about the markets today, and equally and more importantly, where we're positioned. I promise to be brief. I know you've all been in your chair for a long period of time. But I think, look, the single most important thing that we realize at this point is that when you look at where the markets are today, the tailwind is clearly subsiding. And you're beginning to see a little bit of it globally, but you're certainly seeing it domestically and in the United States. As it was alluded to earlier, whether it's been tax cuts, whether it's been all kinds of pro-growth initiatives that have occurred in the United States, we are at a point now where it's hard to envision the next 12 months having anywhere near the same level of sustainability that what has occurred in the last 12 months. And, you know, that's the thing about markets. They are wonderful discounting mechanisms. And the returns that we enjoyed last year have materially come from the economic data that we are now receiving today. And so I think as we position our portfolios going forward, a lot of it is in that context. When there is no longer a tailwind, it means that everything counts on earnings. So you can no longer look at any one company and say, well, it's part of an index or an ETF or something where the rising tide will actually help lift that boat. So for us, it goes back to the very fundamental work that we do every single day. This is actually a really exciting time for us. I know it can sometimes be a little nerve-wracking and disheartening for people, but one of the things that we really want you to know and understand is that we are tremendously focused on the fundamentals of the individual businesses that we own, and we have not wavered from our process or how we think about idea and idea generation. And we are very excited over the next couple of years. We are very bullish on what we call opportunity. And opportunity comes in multiple forms, but I would say for us, it really centers around some of the things that occur within the economic environment, quite certainly. But really, there are a lot of self-help stories. And self-help stories are those businesses that just generate prodigious amounts of cash that often have a beneficial environment where they can actually redeploy that. And if they can't, they can find ways to help manufacture earnings per share growth, whether that's through some level of share repurchase without levering their balance sheet, whether that is being able to make a strategic acquisition in an environment, while rates may be going higher, and we do certainly have that view, it still means that they're able to do it at a cost of capital that is appreciably below that it has been historically. The second thing that I just wanted to mention is that you know, we are obviously aligned in everyone's view that interest rates are going higher. Central banks have clearly changed policy. You can either see them veering or slowing, or if you look in the United States, we're actually now going the other way, where we're removing stimuli. Those clearly have long-term implications. And in the last decade, there's been about $12 trillion of assets bought by central banks around the world. And that has been, you know, the underlying, you know, level of volatility has diminished so materially because you've always had this constant underlying bid, and that is starting to go away. And so with that, it also means that you need to be a lot more focused on how you think about not just portfolio construction, but as I said earlier, idea and idea generation. The last thing, and again, it was touched upon by our panel, but it's clearly the political environment. You know, we have whistled past the graveyard on a number of issues. It seems as though we're reaching a little bit of the tipping point, certainly in the United States, whether it's NAFTA, China, Russia, the constant, you know, change within his cabinet. But Trump is clearly raising some alarm bells. It's been going on for a period of time, and the markets have sort of absorbed it all. And I think that, you know, as you look forward, it's a lot harder to be in a position where the overall change that can occur can be viewed as very positive for earnings. Because at the end of the day, there's really only two things that make stocks go higher, and that is earnings per share growth and multiple expansion. And if we are at the end of the proverbial tailwind, we're probably at the end of multiple expansion. which, as I said earlier, means you have to be tremendously focused on how a company can generate profits and where they redeploy those profits for better returns going forward. So I'll briefly touch on where we are around the world, but as I said, I'll be sure to not take much time. In Canada, approximately 50% of the revenues generated from our Canadian companies are outside Canada today. So we also subscribe to much of the view that's been talked about. We still think that there are opportunities in Canada. It has been a tremendous laggard. A lot of the poor economic data, a lot of the poor corporate performance overall, I would say, has been well recognized in the market. There is no doubt that there's been a flow of funds issue. We're not certain as to when that sort of changes gear, but what I would say is that we feel very confident in the businesses that we own are going to be able to take advantage of the environments in which they are able to invest. In the United States, I would say that there's a couple of themes that we have. I mentioned self-help stories earlier. I would say things that have exposure to a rate-rising environment. So if you can think of some of the financials, the balance sheets on many of the large money center banks in the United States are better than they've been at any point in the last 50 years. They are able to command profit in a way that JP Morgan in the last 5 years has generated about $25 billion a year of annualized profit. And the opportunity set that goes with all of that cash that gets generated, as I said, either to continually grow their dividend or to find some way to be able to repurchase stock in that environment, I think is extremely positive. And then just briefly touching outside North America, where the vast majority of our capital has shifted over the last couple of years, I would say that we still remain quite optimistic on idiosyncratic or stock-specific ideas in continental Europe, but we are believers in long-term Japan. I know that's hard to fathom because it actually has been 30 years where there's been tremendous challenge, but we think that they are going to be obviously the last to leave the party. We think that there are a lot of corporate initiatives that are occurring right now that are extremely positive. And most importantly of all, we like it from a valuation perspective. So you have the opportunity to be able to buy corporate profits there, particularly domestic-oriented corporate profits. And we also enjoy a bit of a tailwind associated with the currency. So a lot of what we're thinking about, is how we position our portfolios, not just from an idea generation perspective, but also from a currency perspective. And so with that, I wanted to thank you all for joining us today. We are thrilled to have this esteemed panel, and we want to thank them for their time and for their thoughtfulness. We also want to take the opportunity to thank all of you. It's such a pleasure. We really appreciate your trust and confidence. A lot of our investment team is here, and as you know, a lot of our client service group is as well. So with that, thank you very much, and we'll look forward to seeing you at the next event.